Receiving the grant of probate can feel like the finishing line, but in reality, it is the point at which much of the executor's work can finally begin. The grant gives you the legal authority to collect the estate's assets, deal with the property, and eventually pay the beneficiaries. But in doing those things in the wrong order, it could leave you personally responsible for unpaid debts or missing money. Hi, I'm James. I've been working in the probate sector for over 10 years now, and in this video, I'll explain 7 key steps an executor should take after probate has been granted. And do stay until the end because I'll explain the crucial distinction that many executors miss. The grant may give you permission to access the estate, but it does not necessarily mean the estate is safe to distribute. So, step 1. Check the grant carefully. When the grant of probate arrives, your first job is simply to check that the information on it is correct. Check that the deceased's full name, address, and date of death. Also check that the correct executors are named. The grant will normally show the gross and net values of the estate declared when the probate application was made. Make sure there is not an obvious error in those figures. If something significant is wrong, do not simply carry on and hope that it will not matter. Contact the probate registry or take legal advice about how it should be corrected. You should then keep the original grant somewhere safe. Most banks, investment providers, and other organisations will accept an official sealed copy, which is what you're sent from the probate court, and avoid sending the original document through the post unless an organisation specifically requires it. The grant is your evidence that you have authority to deal with the deceased estate. You may need it repeatedly over the coming months. But receiving the document does not automatically release any money. You still need to contact each organisation and complete its own closure and encashment process. Now that brings us on to step 2. Now, if you are finding this helpful, please subscribe to the channel for more clear, practical probate guidance. Step 2. Collecting the estate's money and other assets. You can now return to the banks, investment companies, and other organisations that told you they needed probate. Send them the grant together with any forms and identification they require. Ask them to close or transfer the deceased's accounts and release the money to the executors. Do keep a record of which organisations you've contacted, the date that you contacted them, what documents you supplied, how much you expect to receive, the amount that was actually received, and where the money was paid. Do not be surprised if this takes several weeks. Every organisation has a different process and some are considerably faster than others. Now, where practical, estate money should be kept separately from your own personal money. For a larger or more complicated estate, the executors may wish to open a dedicated executor's account. Basically, mixing estate money with your own current account can create confusion and make it much harder to produce accurate estate accounts later. You may also need to sell investments, collect life policy proceeds, or transfer particular assets directly to beneficiaries. Property requires separate attention, which I'll cover shortly. But before moving on, I've created a free email newsletter providing practical guidance for executors and families dealing with probate. You can join using the link in the description below the video. I will send you straightforward probate tips and let you know when I publish new guides and videos. Now, collecting the estate money may make the estate look ready to distribute, but first there is a less exciting stage that protects both the beneficiaries and you as executor. Step 3. Establish and pay the estate's liabilities. Before paying beneficiaries, you need to identify and settle the estate's debts, taxes, and administration expenses. These might include things such as funeral costs, credit cards and loans, household bills, care fees, council tax, income tax, inheritance tax, professional fees, property expenses, money properly reimbursed to an executor. Do ask creditors for final balances rather than relying on an old statement found among the deceased's papers. You should also consider whether there could be creditors you do not yet know about. Now, one way an executor can protect themselves is by placing a deceased estate's notice in the Gazette. I've included a link in the description to this. The notice gives creditors 2 months to come forward before the estate is distributed. Government guidance warns executors not to distribute during that period. If the estate is paid out and an unknown debt later emerges, the executor could potentially have to meet it personally. A Gazette notice is not compulsory in every estate, and it does not protect against every possible claim, but it is definitely worth considering, particularly where the deceased's financial affairs are unclear. Be especially cautious if it appears that the estate may not contain enough money to pay everyone. An insolvent estate has strict rules governing which debts are paid first. Do not pay creditors or beneficiaries selectively without specialist advice. This is one of the situations in which trying to save money by handling everything yourself can expose you to much larger financial risk. Step 4. Deal with any property. If the deceased owned a house or other property, the executors must decide what should happen to it. Usually, the property will either be sold, might be transferred to a beneficiary, or appropriated towards a beneficiary's entitlement. It could also be retained for a period while the estate is administered. Now, the wording of the will really matters here. A property left specifically to one person is different from a property that forms part of the general estate and must be sold or divided among several beneficiaries. If the property is being sold, the executors can now provide the grants to the conveyancing solicitor and proceed with the legal transfer. Continue dealing with insurance, securities, utilities, and council tax while the property remains part of the estate. Do not assume that these responsibilities end merely because probate has been granted. Also pay attention to the sale price. If property, shares, or indeed investments have increased in value since the date of death, selling them may create a capital gains tax liability for the estate. Transferring an asset directly to a beneficiary can have a different tax result from selling it during the administration. That does not mean a transfer is always better. The will, the wishes of the beneficiaries, available cash, tax position, and ownership arrangements all need to be considered. Where a valuable asset has risen substantially in value, take tax or legal advice before deciding whether to sell or transfer it. Step 5. Deal with tax during the administration. Many executors believe that tax was completed when the inheritance tax position was dealt with before probate. That is not always the case. The estate may continue to receive income after the death, including bank interest, dividends, rental income in some situations, or investment income. The estate may also make a taxable gain when an asset is sold. This period between the death and the final distribution is known as the administration period. Depending on the figures and circumstances, the executors may need to report estate income or gains to HMRC and pay additional tax. I would suggest to keep every tax certificate, dividend statement, completion statement, and interest calculation you receive. Do not distribute every penny and then attempt to deal with HMRC afterwards. Retain enough money to cover any anticipated tax, fees, and final expenses. This is one of the reasons that an executor should not promise beneficiaries a precise payment date simply because the grant has arrived. And there is another reason to be cautious, which we will cover in step 6. Before we do, if you are considering using a solicitor to administer the estate, I've included a link below where you can request a free initial consultation. So, step 6. Consider claims and disputes before distributing. Before paying the estate, ask whether anyone might challenge the will, dispute the administration, or make a claim for financial provision. Certain relatives and dependents may be able to bring a claim under what's called the Inheritance Provision for Family Independence Act 1975. The normal time limit for such an application is 6 months from the date on which the grant was issued, although a court can sometimes allow a late claim. That does not mean every executor must automatically freeze every estate for 6 months. The correct approach depends on the circumstances and the apparent level of risk. But distributing the estate while you know that a serious claim is threatened could create major problems. Warning signs could include such things as a close relative being excluded from the will, someone who is financially dependent on the deceased receiving little or nothing, allegations that the deceased lacked capacity, claims that the deceased was pressured into making the will, a disagreement about possessions or property, or a beneficiary already threatening legal action. Now, if a dispute is possible, do not try to resolve it by quietly paying everyone before anyone can object. Pause, the distribution and obtain specialist advice. Even when there's no dispute, you should confirm the identity and current address of every beneficiary before sending money, and be particularly careful with any bankrupt beneficiaries who have died, any missing beneficiaries, children, so that is people under the age of 18, and anyone whose entitlement is held in trust. Now, the final step is where many executors discover that the amount available to distribute is not the same as the figure shown on the probate application. Step 7. Prepare the estate accounts and distribute safely. Once the estate has been collected, liabilities and tax have been dealt with, and any appropriate waiting periods have passed, you can calculate what is available for the beneficiaries. This is where proper estate accounts become essential. The accounts should provide a clear financial record of the administration, including assets and values at the date of death, money actually collected, income received during the administration, debts and expenses that have been paid, property or investment sale proceeds, tax paid, payments made to beneficiaries, and then the final balance available for distribution. Now, the figures may differ from the values used in the probate application. For example, a property may sell for more or less than its probate value. Investments may rise or fall, additional interest may have been received, and previously unknown bills may emerge. That does not automatically mean something has gone wrong, but every material difference should be capable of an explanation. Now, before making the final payments, check the will again. Make sure you understand any fixed cash gifts, specific gifts of possessions or property, who receives the residue of the estate, whether a beneficiary's share is subject to an age condition or trust, what happens if a named beneficiary died before the deceased, whether earlier payments or loans affect anyone's entitlement. You may sometimes make an interim distribution before every final detail is complete, should you wish. For example, if the estate clearly contains ample money, you might pay part of the beneficiary's entitlements while retaining a sensible reserve. But an interim payment should be based on proper calculations, not pressure from beneficiaries. Explain clearly that it is an interim payment, record it in the estate accounts and obtain receipt. Never distribute the entire balance until you are confident that all remaining tax, fees, debts and administration costs can be paid. After the final accounts are agreed and payments are made, obtain confirmation from beneficiaries that they have received their money. Keep the estate records, accounts, correspondence and supporting documents safely after the administration has finished. Now, if you are handling the estate yourself and want a more detailed step-by-step guide, I've linked my complete probate guide below in the description. Now, at the beginning of this video, I did promise to explain the distinction that causes many executors problems, and it is this, that the grant of probate gives you the authority to deal with the estate. It does not certify that the estate is ready or safe to distribute. Think of the grant as the key that opens the door. It allows you to collect bank accounts, sell or transfer assets, and prove that you are the authorised executor. But it does not confirm that every debt has been found, every tax liability has been settled, no creditor will come forward, no claim will be made, your distribution calculations are correct. Government guidance sets out the order plainly. First, pay the deceased's debts and taxes, and then distribute the estate according to the will or the law. That's if there is no will. So do not treat the arrival of probate as permission to immediately divide whatever money is available. A careful executor collects the assets, checks the liabilities, deals with tax and claims, prepares proper accounts, retains an adequate reserve, and only then pays the estate safely. If you found this useful, do have a look at the channel for more practical guidance videos about probate, and thank you so much for watching.